Hi, everyone. I hope this message finds you doing well. I'm David Silver, CEO of Instrumental Wealth, and joining me today is Matt Harbert, Chief Investment Officer of Instrumental Wealth. And Matt, a lot of new things took place in the first quarter, economically speaking, in addition to the inflation that we've seen in most of 2022. And the Fed aggressively raising rates. We had the banking crisis that took place a little over 45 days ago. So lots to discuss here today. Let me go ahead and turn it over to you, and let's actually start with the banking crisis that took place just 45 days or so ago.
So with the banking crisis, we had the second and third largest bank failures in the U.S. That's Silicon Valley Bank and Signature Bank of New York. So basically, in a nutshell, what happened is when you look at banks, they make money by bringing in deposits, and they take those deposits and they use them to make loans.
Right.
The spread between the interest rate they charge on making those loans and what they pay on deposits is how they make a profit. In addition to that, banks will typically keep a portion of those deposits and keep them liquid, put them into things like treasuries and mortgages and things like that, in order to meet any expected withdrawals. So what happened is over the past year, the Fed significantly increased interest rates. And that put downward pressure on the value of those liquid assets these banks had put aside. So that coupled with high inflation costs rising for the depositors, withdrawals that they had estimated exceeded what they expected, and additional deposits were lower than what they expected as well. So this actually forced the banks to sell their liquid assets at large losses, and this put big holes in their balance sheets. This resulted in depositors being spooked, and then a classic bank run occurred. So following that, regulators took action to prevent contagion and restore confidence in the banks. So the first thing they did was to guarantee all depositors would be made whole, and this included any uninsured deposits as well, which is anything that someone may be holding at a bank above $250,000. They also created what they call the Bank Term Funding Program, which provides additional funds to banks in order to meet any depositor needs they may have. What this basically is the Fed will provide funds to a bank and allows them to put the assets they have up as collateral, but do it at par. So the Fed does charge a modest interest rate on that, but it does eliminate the issue of the loss in asset value on their balance sheet.
So essentially, if I had, $100 billion of treasuries that, because of the interest rate spike, is now worth 70 billion, I can pledge those as collateral and get a loan for $100 billion is essentially how that works. So if they have a run on the bank, essentially they have the liquidity to provide it and not take the loss.
That's right. So basically what that means is regulators have essentially signaled that they're not going to let any bank go down because they have such a fear of contagion. It really begs the question then, is the crisis over?
Right. I was just going to ask you, is it over?
Right. So good news is that, the crisis really was driven by risks that were specific to individual banks, as opposed to something more systematic in the financial system. These banks had high customer concentrations. They had a large proportion of uninsured deposits. There was heavy exposure to risky industries like startup tech, and frankly, they had poor risk management. On top of that, policymakers did take aggressive and swift action to protect these deposits and restore confidence in the banks. The bad news is, we will be feeling the effects of this. Regulators, they're going to be, adding more regulations. It's going to add tighter credit standards. The banks are going to be less, they're going to increase their credit standards. There's going to be less credit available. And on top of that, there's actually another area that we have to keep an eye on, and that's the commercial real estate. So commercial real estate just might be kind of the next area of stress on regional banks. Regional banks happen to be the biggest provider of commercial real estate loans. And investors are, as they're digging into the balance sheet of regional banks, are starting to be a little bit nervous as they're analyzing the risks that they may have. And these commercial real estate loans, there's a significant number of them are going to be coming up for refinancing over the next couple of years. That's unfortunately going to come at a time with higher interest rates to refinance, and as well as they're also facing low occupancy rates in particularly office space. And that office space does make up a significant portion of commercial real estate. Some estimates are that occupancy rates are as low as under 50%. This obviously is driven by a secular shift to remote work, and this
Right.
may actually change the office market permanently. So this does have a chance of increasing the default rates on these loans, and banks are being forced to set aside more money in order to shield against these expected defaults. So when you have the tighter lending standards added to the risk of defaults on banks' balance sheets, profitability is likely to decline significantly for regional banks. And this decline is, potentially could lead to more bank closures, mergers, both of which would cause a significant downturn in the sector. So is the crisis over? We don't think it's over. It is stabilizing, but as we mentioned, there are effects that are going to continue in the economy with tightening lending standards. On top of that, we do have to keep an eye out on commercial real estate. So it's probably not over yet.
Right. Right. Yeah. Well, certainly we'll see what cards are next there, what unfolds next. But we'll be keeping an eye out on it and see what happens there. So, Matt, let me turn it over to the economy here. And I know inflation, as I mentioned earlier, sort of been the big event that took place in about midway through 2021, and of course all of 22, and of course the Fed's response to that and the rapid rate hikes. Let me turn it over to you to talk through some economic updates on inflation.
Sure. Currently, inflation, both the headline and core numbers, do remain elevated. They're well above the Fed's 2% target rate, with the headline sitting around 5%, and the core, which excludes food and energy, is sitting around 5.6%. The path of inflation, however, has been moving in the right direction. So when we look at the headline rate, we can see that it peaked back in 2022, back in June, at 9.06%. And it has been consistently falling since then to the current rate of 5%. When we look at the core rate, it has also been falling since last year, although it's been a little bit stickier. It peaked a little bit later, back in September as opposed to June, and it peaked around 6.3%, and it's been coming down, but a little bit more modest. So it's now currently at 5.6%, and in March it actually reversed trend and increased a little bit at that point. But if we look at the individual components, we can really narrow down where the stickiness is occurring. So you can see that the core commodity prices have been decelerating since September. It's really in the core services that we see that stickiness remaining, particularly in the transportation and shelter area. So really that begs the question, where do we think inflation is going to be by the end of the year? Well, we think inflation is possibly going to reach about 3.5% to 4% by the end of the year. As we've seen, shelter is one of the sticky areas, but it's heavily weighted to something called housing's owner's equivalent rent. And that has a significant lag to it. And so we think this number should start to come down going forward,
Right.
particularly as we'll see later, the housing sector has softened pretty considerably over the past several months. You combine that with the Fed and their tight monetary policy, which we think is going to continue to be a headwind to growth, may even push us into a recession. So we think this is going to add downward pressures on prices as well.
Yeah. So, Matt, I think based on this, I mean, where do you think rates are going?
Yeah. So when we look at the Fed really has made it their primary focus over the last year to lower inflation. It's been well above their 2% target rate, as we noticed, and they've raised the Fed funds to do so 475 basis points since March of last year. This is the quickest the Fed has hiked in history. And as we discussed, inflation has peaked and has been trending down since mid-2022. So we think the Fed has done enough. We don't think the Fed needs to hike rates any further at this time, as we're already seeing a slowing in the economy and inflation is trending down. There is typically a lag between Fed policy and its effects on the economy. So taking a pause to evaluate the effects of the policy they've already had, we think would be prudent. However, the FOMC has indicated that they believe hiking further may still be appropriate. So we give about an equal chance of the Fed hiking or pausing in the next meeting. If they hike, it will likely be probably a modest 25 basis points and potentially pause after that. So that's kind of where we think the Fed is in their policy.
Yeah. So I guess, Matt, here's the $1 million question, right? Is a soft landing still even possible? Or are we going to end up in a recession?
Yeah. So in order to answer that question, why don't we look at a few areas of the economy? First, let's look at housing. If you look at the chart, you can see when we look at any of the factors from permits to starts to housing sold, really there's been a significant slowdown over the past year. This is driven by 30-year mortgage rates, which are climbed up above 6%, and even the 15-year rates are just under 6%. The housing market index, the new home sales, did tick up a bit in March. However, the trend still remains one of softening. So overall, the housing market is starting to slow down and has been. Next, if we look at the consumer, first looking at retail sales. Retail sales has also been slowing down. It's even dipped below the 10-year average. However, if we look at personal spending overall, it is still remaining positive. And actually in January, it was very, very strong. But November, December, and February were below average. So while prices in the economy and inflation have increased significantly, consumers are still relying on different factors in order to support their spending, and that is they're dipping into excess savings and adding to their credit card debt. So when we look at that, you can see by looking at the personal savings rate, it's well below the average rate over the past year or two. So it does show that they're dipping into their current savings in order to keep up their spending. So when we look at the lower left chart, we can see that debt, just the overall level of debt has significantly increased. But when looking at the lower right chart, we can also see as a proportion of disposable income, it is also really increased as well. So both excess savings and credit card debt are areas that the consumer has been relying heavily on making up for their spending habits in the face of rising prices. But neither of these do we think are sustainable in the long run. So we do think that there's going to be more headwinds to GDP growth as access to these sources start to dwindle.
I think the consumer came into this so strong, and as we saw in the chart just above, obviously the savings rate during the COVID lockdown was significantly higher than the last 50, 60 years due to the fact that everyone was locked up. So there was a lot of pent-up demand. A lot of the consumer had a very, very strong balance sheet coming into this slowdown that we've experienced. And of course, now people are dipping into that savings and ultimately starting to accrue credit card debt. So the rubber's got to meet the road at some point. So certainly not a positive sign there.
That's right. So when we look at business spending, so when we look at new orders, they're a pretty good indicator of what spending will be like by businesses in the future. And this has declined quite a bit. And in fact, in January, it hit a level of 42.5. And at this level, a recession has followed in all but one period, which was just after World War II. Also, if we look at capital expenditures, really haven't come down yet, but a good kind of leading indicator of capital expenditures is operating earnings. Operating earnings have a tendency to lead capital expenditures because companies will generally cut back in spending when profits decline. So you can see here that we've had quite a bit of decline in operating earnings. It's actually declined in each of the past 3 quarters. And so we do expect that there will be this will have an effect on capital spending. So over the next year, we do think capital spending will start to come down in response. On top of that, as we discussed earlier, we do have tighter credit standards coming out. So with the banking crisis, the credit standards are tightening. That gives less access for companies to be able to spend on capital projects. So we do think that's going to be an additional factor that's going to be a drag on capital spending going forward. Now, while the standards are tightening because of the banking crisis, it was actually something that was already occurring out there as banks were sort of preparing for the idea of a recession. And we can see that when we look at a couple of surveys. The first one is the Fed Senior Loan Officer Survey. This is where the Fed actually asked different banks, are they tightening or loosening their credit standards? And as we can see by this chart, it is showing a big increase in the bank's response that they're tightening credit conditions. Of note, this is only through 12/31 of 2022. So this shows us that tightening was already starting to occur in the economy. And it's with the banking crisis, we just think that's going to be an added effect to this. So that will just tighten things further. In addition to this, we can also, the NFIB has a survey, the small business survey, that in that survey, they ask them about their credit situation. And in there, a net 9% of those that reported did say their last loan was harder to get than their previous attempts, which is actually up 4 points. So overall, we do think this is all going to have an effect on business capital spending.
A lot going on there, Matt. Maybe you could jump into employment next, because I know that that's a big area too that is important to understand.
Employment is actually an area that still remains at robust levels. You can see on the bottom part of the top chart, the unemployment rate, it is still very, very low. However, it does look like the growth in employment is starting to slow down a little bit. So when we look at this bottom chart, it does show that additional jobs that are being added for most industries are below the 6-month averages. So it does appear that while employment remains strong, the additional added employment is starting to slow down a little bit. Now, if we look at the labor market overall, we can see that it does still remain tight. So overall, the labor market continues to be tight, but it is loosening up. So when we look at openings and hires, both of those have been trending down from their peaks back in February and March of last year. But you can see where it stands above the dotted line, they are still well above their average levels. Quits have also been trending down, but they did pick up a little bit in February, and they are still above their average levels as well. And then finally, layoffs really been pretty stable at or just a bit under their 10-year average. So we do see loosening up in the labor market and it's tightening, but it does still remain pretty tight at this time.
There's still a ways to go there with getting back to a neutral position there.
That's right. And then lastly, we can look at a couple of predictors. So the first thing that we can look at is the LEI, the leading economic indicator. And this really, it's comprised of a group of indicators that have all done well in giving some prediction of how the economy will do going forward. It's broken out into a financial component and a non-financial component. So as we can see in the bottom chart, these are each of the components, and all but one of the financial components and all but one of the non-financial components are negative. So then if we look at the top chart, this kind of puts it all together to give us an idea of what it's going to predict at its level. And at the level it's at currently, it is indicating that there will be a recession sometime over the next 12 months. And then lastly, we can look at the yield curve. So the yield curve has traditionally been a very strong indicator of a future recession when it inverts. It usually has a lag, so once it inverts, usually we have a period of about 12 to 18 months before a recession occurs. And when we look at the 10-year to 2-year period of the curve, that actually inverted back in July last year. So it's been inverted for 9 months. So when you put kind of those numbers together, this signals that we should be entering a recession sometime by the end of the year. So really kind of combining all of these elements, we look and we can see there are several areas of the economy that are starting to flash red. Retail sales has slowed down, manufacturing new orders has come down, and there's been a decline in businesses' operating earnings. We don't think we're currently in a recession, as there's still areas of strength. So overall, personal spending has remained strong, and capital expenditures have not come down yet, and employment is still robust. However, we do think in each of these areas of strength, there are some problems. So when we look at the factors that have been supporting consumer spending, we don't think those are sustainable in the long term. So we do think that that's going to come down. As we looked at the decline in operating earnings and tightening credit standards, we think that's going to have a pretty big effect on capital expenditures. So we think business spending is going to decline as well. And then employment again has remained strong, but we can see it is, additional jobs are starting to weaken and the market is loosening up. So we do see some headwinds there as well. Then when we add to that some of the indicators out there, like the leading economic indicator and the yield curve being inverted, both of those are indicating we should be coming up with a recession. So really looking at all this, we think there's a pretty high probability that we will end up in a relatively mild recession by the end of the year.
So Matt, thank you as always for this. I know our clients always love to hear from you, and there's a lot of material in here that you've gone over and unpacked here for our clients, and I know that they're super appreciative of that. And so I really want to thank you here for all of your input and your overview. Certainly to our clients, if you have questions around this and you want to have a deeper conversation, go ahead and hop on our website, instrumentalwealth.com, schedule some time with your advisor. We'd love to have a deeper conversation with you around this and how it affects your portfolio and some of the actions that we've taken as an investment committee around a lot of the economic data that Matt covered. So thank you, everyone, and enjoy the rest of your day.